Hi everyone, welcome to the last week of the year for trading, and next week is going to be the start of the holidays. So uh, the market has already kind of taken that into account. So today we are back here with Amin from EarningsWatcher and Dan. So this is our second session together. So happy to have you back, guys. Welcome.
Great to be here. Thanks for having us.
Yeah,
Um,
thanks, Fabio.
So today, guys, we are gonna go. So Dan, for those who have been following us, has been doing a lot of live sessions over the past year, showing us how we can use our models and our data to basically place option trades. So today, we're gonna go over our platform together with EarningsWatcher's platform and see how you can combine earnings data and earnings analysis with volatility, gamma, and more. So I'll pass it on to you guys to introduce yourself, and then Dan, take it away.
Cool. I'll just say a few words and then I'll let Dan take it over. Glad to be here. As Fabio said, this is our second collaboration. I think it's a great use case to show how to combine both data, both platforms for basically these specific earnings events. As you know, a lot of things happen on earnings, and so it's interesting to combine the different insights and different metrics. Dan here is in a great setup. He's a big member of both of the platform, and he does this very well, combination of using both in his really data-driven workflow. So happy to show everybody how using smart data and combining different tools can help you get an edge and calibrate these smart trades. Earnings or outside of earnings, it's really about following that edge and following the right data. So I think this is a great use case. So thanks, Fabio, for having us.
Thank you. Pleasure.
Okay, thanks very much. I'm happy to be here again and do some maybe not Christmas special, but pre-Christmas special. And one of my favorite stuff and favorite trade strategies is earnings, everything around earnings. And we're going to deep dive into the classical earnings strategy. Most of you know me already. I'm Dan. Been doing a lot of trades here for you on MenthorQ, but also for EarningsWatcher. And I'm very happy that these two great platforms give us the opportunity to see what you can see in both of them and combine basically the idea and levels, and basically because both of them are fundamented on quantitative trading, has nothing to do with lagging stuff. It's real stuff, and that's why we're going to deep dive into both of that. What can you make of trading and trading earnings? And the special thing is earning week is around the corner, I would say, even if not in the full force, but it's slowly coming, because I was seeing some of my favorite, especially short vol trades, and we're gonna deep dive into that in a second.
It's heating up, Dan, so in a couple of weeks we'll have plenty of fun.
Yes, it's the good thing is, as long as the administration in the US is leaving it at four quarterly reports, we're going to have a lot of sessions if they change it too, but it doesn't change the volatility, and the things are there. And the important thing is to remember why we do what we do. If we're a trader, if we're a pro trader, we make our living from it. If we're a retail trader, we strive for consistency and maybe becoming pro. So you need the right tools, and trading the markets is maybe one of the biggest challenges you will have in your life. And if you have found your way here into this video and seminar, then basically you're right on track, because with the right tools and the right mindset, you can at least try to get into these 30% of traders which can be successful, and your aim would be in the 10 to 5%, having consistency on the long run. And it's a combination of many things, and especially using data the right way, because today data is everything. So that's why we're going to focus on one of these niche things which the market really can't take out of the hands of retail traders, and this is earnings, because this high volatility trades, and the market can't really predict that. They come close to it, but that's why we try with the best data we have here to get very close to getting trades on which give us high conviction and high win rates. And we can't win all the trades, and especially if I look at my stats here at EarningsWatcher, a lot of my losing trades is because I forget to close the trades, which I don't do in my real account, luckily. But today it's about giving you an insight how you can understand from historical patterns and other sources, plus adding gamma levels, look at the positioning, look at skew and other stuff, how you can enhance an earnings result trade and maybe manage and maybe make some money even after that. So I don't know if you two want to add something. Otherwise, I would start basically with a simple routine, and we pick off where we left off last time.
Yeah, sounds good. And also, guys, if you have questions, please post them in the comment. We can go over Q&A at the end. Any question for me or Amin or Dan, please don't hesitate to send them. Again, this is to show you guys how you can build a routine using data with both platforms. So I think we are very excited to see what you have, Dan.
Yeah,
sounds good too. Yeah, data is the new oil, as people say. So right on, Dan.
That's exactly the thing. So we start here in the EarningsWatcher platform, and just for a start, you can also start in the MenthorQ platform. It doesn't matter. You will come from two sides. And what do we trade here? We trade volatility. That's the main thing. Yes, we do trade theta, but the main thing here is volatility. And I'm specifically still, and we thought about doing something else, but we decided again to deep dive into the earnings result, which is the main event. That's why I'm going to make a very short recap what we're talking about. So basically, earnings are happening quarterly for all companies in the United States, and volatility is one of the parts of options which drives the price you are seeing in an options chain. And basically before an earnings, because there's a lot of uncertainty, volatility will ramp up. Can you make a trade there and win? Yes, but Amin has shown in one of his tools here, we won't deep dive into that. We will do that in some other time, how you can make money by this ramping up. But the main money you will make, and that's why we're going to focus on that, is basically other trades which are happening on the earnings result day. Why is that? Because till the earnings result day, uncertainty is huge. The market is positioning themselves. A lot of institutional traders, they have long-term positions, and they will try to nudge these trades into some direction or buy protection. And this can basically, if an earnings result comes out and there is an EPS beat or a miss, depends on that, plus the algos which will try to interpret that, this can help you make money. And how is that? Either that price really drives up and down. You could make money on a very simple long call or a simple long put, if you have got the directions right. Yeah, but this is more of a coin flip. There are some statistics, we can look at some positionings, but it's more of a coin flip. We normally want to make money with things which we can predict, and things which we can't basically take out of the equation, because we have to think like a business. We have to find consistency. We have to make money when the steam train is rolling towards us, always in the options, and we have to be fast. And how can we make money with an earnings result? We can make money with an earnings result if we sell high volatility, or if we believe that volatility, even if it's high, we buy it because the price action after a trade normally will be bigger. Of these two strategies, both are well documented here, both work very well, but for most traders around here, and especially for traders also using MenthorQ, you are accustomed to selling premium because you have all these great levels where price normally doesn't go if nothing really, really bad is happening. So you're very safe. Using the swing models and all the other stuff, we will take a look at that, how you can incorporate that when setting up a trade later. So you are accustomed to selling premium. You make premium normally through Theta and sometimes through Vega, which is volatility. Today, we want to basically focus on if IV goes up and after the earnings result right away, IV starts to drop. It doesn't drop like a hard rock right away, but it drops really in a high. From the high levels it can drop more than 50 to 70% sometimes. And how do you make money? If you choose a strategy that takes advantage of that. So that's why today, again, like last time, we're going to focus mainly on short volatility trades where you trade the high implied volatility before an earnings result. You take advantage of that. You get your premium from there, and you basically put your bet. I'm saying bet, basically, we're going to do this data-driven. Your bet is that it happens what happens every time, that volatility is gonna go down like a hot stone at some point, and you stay in the levels you have chosen. So without further ado, let's go on and see how we can do that and not being in the game of a flip coin or just the casino, because we want to be the smart casino always when we deal options. In EarningsWatcher, you have a lot of things here, great stuff. You can go up and create your plan. You have daily events and everything. We're going to take a short look for all EarningsWatcher viewers today at MenthorQ, what you find there, but let's start here. So a nice thing I always like to start is with a calendar. And let's say for tomorrow, we have stock. You see it's still pretty light here. If you want to see the whole week, you see the whole week. There are some ones. My old friend Nike, which used to be a stock which didn't move much, but always moved when I played it. So when I reversed, this is one of the few stocks I can't get wrong, right? So that's why we're not going to do Nike. This is like a nemesis for me, but all other ones are working. So Nike is the nemesis. But the good thing here, you push on the liquidity option button, and then you can see all these plays here. If you want to make things very simple for yourself and don't see so much numbers and get confused, Amin has developed a very nice algo which will help you find the right trades. We talked about short vol this week. There we are. We have a short volatility trade and we have a short volatility trade which is prime. This means this is a short volatility trade of high conviction. Is this a trade where we definitely gonna win? No, anything can happen. Like Mark Douglas says, if you put on the trade, anything can happen. You should be ready mentally to take a loss and move on and have more winning trades than losing trades. But this is a trade basically where we can see on 10 years that the implied move, like what the market prices for the stock to move, it has only 25% of the cases it has beaten that implied move. So if we sold what the market believes the stock is going to move, or at least the average of that, then we would have won in 75% of the time. So you make the math. It's very simple. If you have 75% of wins and you have $75, and if you had $25 of loss, you're still a winner. This is a nice thing. But this is oversimplified. We're going to deep dive into that. So we see here the average move, and we see the standard deviation, and the implied move is 6.4. So it's 0.7 away. We will incorporate MenthorQ data on that. We will see what MenthorQ also gives us a read, because we put out our trades in the last hour of the day. And it's very important that MenthorQ is one of the very few services where you get high quality live data till the last minute and helps you check your positioning. Plus, on the other day when things start, then this is the way where you can take a look at stuff and where you want to manage. But we will explain how you can set it up and how you can manage that. So if I push
Great
here,
point, Dan, just to help you out there. So I think just for context for the audience, you did a great job explaining really this statistical edge, basically the statistical approach on earnings. So it's not about one specific trade that would behave as expected. It's really a statistical approach of, as you summarized, the interesting thing about earnings is there is this market expectation that this high implied volatility that shows up in this high implied move. So it's like the market is trying to price in the upcoming move. The idea here is not to try to predict whether the market is correct or not. It's actually trying to just be based on statistics, on data, to know basically how does that expectation of the market compare to what usually happens, the data of the actual earnings moves, and it comes to not so a prediction of the move itself, more like how confident are we that that distribution of moves and that outlook of past volatility is actually likely and the statistical way. It's sort of a, some people can think about it as a sort of mean reversion, like the classic strategy in a lot of places, but really more about the distribution of moves and all the data. So with EarningsWatcher, with also MenthorQ, when you do this workflow that we'll see, really tries to basically try to make the most out of this discrepancy or this mispricing. Is there an opportunity here of the market, as you said, not always well pricing, or vice versa? So a great point. I'll let you get back to that.
Yeah, thanks, Amin. This is really helpful. And let me switch to the tab where I wanted us to go. It's always good to zoom out, zoom further in, and then get closer, and then get an actual read, not only from the implied, but what the data is telling us from MenthorQ. So let's go on with this here just for a second, and then we're going to switch to MenthorQ, and then we're going to come back to try to build a trade, and then we're going to look at management. We'll look at PEAT, how this reacts. We're not going to do a PEAT trade, but we're going to look how basically you can manage these things. This is one of the most important things, is not only to have consistent wins, but to be able to manage trades which are gone wrong, either because you have set up the trade that already the loss is factored in, and statistically, even if this loss happens a couple of times, you still make money, or basically you even enhance that if you know where the levels are, and you know, maybe close one side of the trade because you know the other side is going to run, or you're going to close the trade and remanage, or you roll out. You can do so many things with options, and that's why we're going to take a deep dive. So basically, you see here, you see on the moves tab, you see a lot of data. You can even just reduce it to where the VIX is, like 14.9. That's very low, one could say, but it always depends how the market situation is. So let's go back to our data for LEN. We're looking at a small stock. Not many of you know it, but it is very, very consistent here, underperforming the implied move. So this is a nice trade one can take. So we look back to 2013. Why? Not because this is the data, the basis of all. This is just giving us a longer perspective. So the average move used to be 5.9, and we have a small standard deviation here. You can see how the outliers are. And you can see, and this is what I wanted you to see, only 3 times out of 15 times the actual move beat the implied move. The nice thing is we can zoom in now, still 5.8, and it still stays here. So let's go into the last 2 years I'm interested in, because companies do change. So it's always good to have the bigger picture and then go to the picture which is basically more actual. So you see the moves have a bit increased, but the standard deviation is a bit lower. Why is this important? Because we want to know if this trade is a trade which, if it goes beyond our strikes, what is happening in the worst case? How do we manage that? What do we do with that? At which gamma levels do we have to look, maybe, which can help us in the end, maybe stop, let's say, a slide or a rush up. The other thing which is very, very appealing here, that we only had LEN beat the actual move beat the implied move only 1 of the 8 times. What happens if you have a short vol trade on the earnings result day? You would set it up tomorrow, because tomorrow evening are the earnings in the last hour. And what would happen if this exactly that happened? Within the first hour, we would be most probably in profit if the trade wouldn't be very close to our outer strikes. And the strikes we had chosen, we had a short straddle, that would be different, but we have a big break-even point. We will look at this in the simulator, but basically we would be very fast in profit and could close this for, like, say 40-50% very fast, because the IV crush rate is starting, and in the end of the day, basically the trade would be a winner, because the average IV crush rate is roughly 30%.
Yeah.
Okay.
I'll just add here to sorry, about these stats we're looking at, to confirm that approach. So not only does it beat the implied very little, as you see here in the last 2 years, only once, but also the good thing is that basically we ask ourselves exactly what you said of, okay, in the worst case scenario, of the trade going against us, so an outlier move outside of that distribution, again, basically the statistics did not show up as expected. This is the right number that we look at. We see that it actually misses that, or actually the left number. Sorry. So when the worst case scenario, when the actual move does beat the implied, it does so by a little bit, just 0.5%. While the other side, when it misses it, and this is what happens in most of the cases, it misses it by much more, by 1.7. So another good set of numbers to reassure us that when it goes against us, if the left number was, a 5% to 10%, it means some stocks are like that, by the way, where heavy outliers, and so we need to be prepared for the very worst case scenario. Here, LEN is showing to be a very low volatility, and even when it doesn't, when it shows high volatility, it's rarely a lot above the implied. Getting back to you.
Yeah, thank you. I mean, this is an important point. So we always need to think not only how much money we can make. Basically, if we set up a trade, we always should think risk return, because return comes from risk. So that's why we need MenthorQ data. And we're just going to open the simulator, and then we're going to switch over to basically to MenthorQ. This is here basically a simulator where very nicely built. You have all the factors of IV crush and everything already factored in. So we just keep in mind that LEN was moving roughly 5.8 in the last 5 to 10 years, and it moves roughly now 6% in the last 2 years. So basically, these are the numbers which we should keep in mind. So without much further ado, let's take a look at MenthorQ. What are we seeing here? First thing is we have a lot of stuff here, a lot of things which we can basically find great trades, but we want to see how LEN would do. Basically, we want to get a reading on what the market sees in LEN. Definitely, a lot of stuff can happen during earnings, but we want to see what the market is seeing. So the easiest thing is to see here that LEN is basically in a very high volatile regime. Why is that? Earnings, IV RAM, very easy. Momentum is very low. So this basically, and let me switch back 1 second to LEN. Just 1 second, very sorry guys. I wanted to show you something. This makes perfectly sense in a lines. We always have to look for confluence. Move of direction is normally downwards. Will this happen this time? Not sure, but statistics don't lie on the long run. So you see a correlation here between low momentum and low opinion. So the next thing is, which I always look, which is my favorite little tool here, which gives me everything I need, but the other tools also help. I try to take a look at the matrix. The matrix might, some data might change intraday.
Sorry to interrupt. I think you need to share this.
Sorry, very sorry. Okay, let me go back. Here you see the Q scores, and we, like I said, high volatility, but the rest is not looking that good. We see momentum really deflating. So let's go to the metrics. Thank you, Fabio. This is always with the switch of the tabs. What do we see here? We see thing like the DAX here has decreased. The delta hedging GAX is also decreasing here, and you see the one-day change in GAX and DAX. This is not little, this is a lot. So basically, we have an expected move till the end of the week of 7 points. And basically, the intraday expected move is 2.3 points. So again, what did we say? 6%, and the expected move in the end of the week was 7, because most probably if we take a short volatility trade, not like long volatility where we like to avoid the heavy IV crush, we're going to do this maybe in some other session. We might sell further, we might buy further out. With a short volatility trade, if we don't want to go for calendar spreads and other stuff, time spreads, we're going to sell in this circle here. So this is a number, because we love the expected move, it tells us a lot. We can remember that MenthorQ has calculated it roughly to 7. Is this good for us? Yes, this is good, because this aligns with 6% we saw on EarningsWatcher. So if you sell something around the 7 expected move, which basically we saw that the market is factoring in, and we know that it stays below that, most probably we're just going to win because we're going to stay within the expected move. What else do we have here for all those people who haven't used the matrix or are not accustomed to MenthorQ data? We have certain levels here. One level is the call resistance, and this is the put support, basically in the high vol level. So basically, the call resistance level is where the biggest concentration of call gamma is on the upper side, and basically it can act as a resistance or a reaction level. And on the put support, normally a move, these levels are more magnets, but again, they repel. That's why they're called resisted and support. Anything can happen on an earnings result, but still these levels have some meaning, and we use and should factor them in when we build our trade. The high vol level is a very interesting level because it tells us where the gamma regime is flipping. Are we in a more stable or non-stable, regime? And the thing about this level is that basically, if we are in a non-stable negative gamma environment, we have more violent moves, and we know that land tends to go down. So what we could do is skew maybe here and skew for the downside and be prepared to manage accordingly if we see these levels broken. But I think you offer so much more. Basically, here you see the GEX expiration for all expiration. It doesn't look that bad. You see a lot of positive DAX, but let's go on. I will make this bigger. We're interested in this expiration, and you see a big nudge here. There we see the 125 gamma call wall, and we see a huge level here on the downside, which can and should act as a magnet, but also a repeller. So we should think about trying to have a break-even point here or somewhere below of that, because if we're lucky, it might get drawn there, but also get repelled.
And
what else?
To that, Dan, like I think another very important part here is that whenever you trade, you always have to have a plan A. So this is your initial idea, and then you need to have a plan B in case things happen and things go sideways. So obviously nobody can predict the future, so it's important that we are reactive to what could go wrong and what could go right. But again, like Amin was saying, if you can build an edge using data, then that's of course a probability game.
Definitely, and we have shown you with MenthorQ and Fabio. We had a lot of videos on that, how you can just, if you want to go directional and keep it simple, and I've shown how you can do on the 20-day swing models. I've shown you how you can play risk reversals, which are more on the risky side, but how you can harvest premium and still make money and have a low risk trade. For example, the 5-day swing model, what does it tell us? We will go out 5 days from today, so you should recheck that tomorrow and see basically if there is an upper or a lower band. An upper band indicates that we most probably are in a bearish regime and that the price 5 days after the trade should stay here. Because we're going to trade the closest expiration, this swing model gives us a prediction further out, because tomorrow it's Tuesday. It will give us basically for the Monday coming, it is telling us that if everything goes as the model predicts, we should stay below the 126. The risk trigger can act as basically a repellent, but also can indicate that if this is breached, that basically we could go down further low. So keep this, the 126 and 112 in mind when we are building our trade. Are there any questions right now?
No questions so far.
Okay. So we could look at skew, how skew has developed basically. At the first expiration, we see here that we are going into the put buyers, something we saw from the statistics, where we saw that opinion is low and momentum is low. And here also, we have been stuck here longer for a month. It goes a bit down. This gives us an indication that it used to be more in a bearish regime. And this is what I love, is the delta. Basically, the DAX chart. Why is that? Because it gives me basically a bias where basic price can trade if certain things happen. Basically, and what we see here, if we keep it very simple, we see more red than green. And how can this help us with an earnings trade, you would ask? No, this is not a momentum trade going into one direction, but it can indicate us where basically the delta hedging is happening. And you can see here, basically we have spot price is at 119, and you see here all this basically. So it will be very hard for price to go up and break that. So most probably this means we are more in a bearish regime, what also we saw from EarningsWatcher. So this could basically help us on the one hand for managing. So we should be ready to manage the downside, have a plan. How do we go out? Maybe if we don't want to do this expiration only and add basically some time spread element. But if we want to keep it simple and do it with a short strangle, which is more risky, or do it with an iron condor or iron fly, we should be ready to know what happens when some of these levels are hit. And that's why these levels are so important. Not going to deep dive into the Vol Surf and other stuff. This is really, really amazing stuff here. And just for a second, because the market is just open, and then I'm ready here, I'm going to move to EarningsWatcher so we can build our trade. This is a page if you are a user of MenthorQ. It's very important because if the day progresses, it's gives you basically actual data. Now we're only at 7 minutes in, so there can't be a lot of data, but let's say you set up your trade and in the last hour you have already found your levels. Then you take a look what happened during the day. If I can go back in time and show you what happened on Friday, basically we should be able to see things. Let me just choose something. I don't know. Maybe, no, there we go. Let me see. Maybe I'm doing something wrong. Let me see. Okay.
Maybe you want to refresh the screen then.
Yeah, I'm going to do that. It's not that important, but it is something I want to put into your mind because basically it is important that you have fresh data every time when you set up a trade. Okay, we're gonna revisit this later. This is not that important. Let's go back to where we can build what we saw.
So this is a great combination, just to Sabine, so as a summarize a bit of where we are. Great use where basically you started by looking at, again, so you found Len from this outlook of how the current implied compares to the past moves, the distribution, how we said to look at the statistical edge. And it's then a great combination with MenthorQ data where you got a lot of insights, especially about just to make it more simple, basically what the option market is seeing in details in terms of these levels, etc. And that helps you to set up a trade based on the volatility outlook you saw, where you confirmed, okay, low volatility, the distribution of moves, those amplitudes we looked at, etc. And you combined it with how the actual market is really pricing in things with these levels and resistance, etc., to know as a further layer, basically, to optimize and know this is where I should be. These are the zones that I should avoid. And so now you have both data and both insights of exactly what you should be aiming for. And as Fabio said, these are, again, probability, as with anything in trading, it's all about probability. And the most important thing is to put the chances on our side, maximize our likelihood. This is the whole approach of looking at this data. And then it's a matter of getting a good risk reward. Usually we would like to win more than we lose, and the edge is really on the repeatability of this statistical goal. Just a quick summary for everyone, but a great presentation so far, Dan.
Yeah, thank you very much, both. And this is something we remembered. We remembered the 6%, and we're going to switch in between MenthorQ and EarningsWatcher now, just to see how you can make these things doable. We also have Quinn. This is something we will show you later, advanced AI with levels. So basically, let's say we keep these 6% in mind. We keep the 7%, which the market has basically factored in. So we know normally we would stay below the 6. Okay. If we say the market has basically said it's going to move 7% from the expected move, I'm just trying to keep it simple and will help you work on. If we go down here, we found in our classics tab, we see short volatility, short straddles, short strangles. The basic strategy would be very close to that and could give us a great return, but also give us, let's say, a 40% lose or 37% lose on the upper side if we break this. And because it's a non-defined risk strategy, this can make sense if you have a high conviction and you know what to do in these kind of situations, but I wouldn't incline, because one thing is for sure, I like strangles, but the thing is, in the end, too much risk takes out everyone. I've never met any trader which hasn't been taken out on the long run when taking too much risk on. So if you want to go and keep it simple and say, okay, I'm going to trade these with the levels I have, and that's the thing. We could think about trading the 129 on the short call and 111 on the long call. We're going to deep dive into that, and then we're going to double check with MenthorQ data. So first thing is, we see here we have 7.5 and 8.4. Is this good? It's not bad, but what did we see from the data? That basically we are more in a bearish regime, and normally we move more on the upside. But for the sake of argument, let's stay here and see what MenthorQ gives us. Before we do that, a high upward move would only be, from the statistics we have, a 7% loss. It's not that much. You could also manage that. On the low, this looks a bit worse. 30%. If you can stomach 30%, you can go for that. I don't know if LAN still, if someone comes and says we're going to buy out LAN and it goes up 50%, yeah, then you have a problem maybe. Yeah? And you should always risk, do a proper risk management, see how much you can lose. And I always say 2 to max 6% of buying power for an earnings trade, depending especially what kind of stock it is. This is a low move stock. You can risk more, but basically we can think of using some other strategy, either time spread or a strategy like an iron fly or iron condor. Let's go back to MenthorQ and see what these two levels mean to us. First thing is, sorry, I have
just
to
jump
open
in
it.
quickly there. So you were looking at the strength also, as you mentioned, quite high in the break even. So encapsulating most of the past moves, this is why the basically likelihood of it is quite high, because as we said, as we saw, that 7 or 8% is quite wide. So it comes with, it seems quite likely, as you said, because the stock is quite volatile. But as you mentioned, in case of a black swan event, these short, naked, pure shorts, straddles or strangles can be in a very tough position. So this is all about the risk reward we were discussing, where depending on the stock, as you said, depending on the outlook, and depending on the risk profile of the person, simple workaround is to cap that, as you said, make it, for example, an iron condor or a butterfly to really cap the max exposure. But it's great basically to rely on both data to know these are the levels I should focus on, I should avoid, or I should get around, and then adjust basically the risk reward for the different structures. So just for everybody, don't be tempted by the short straddle because of the loss, the small loss. This is just the statistical approach. We should also keep in mind the very, very worst case, black swan event, as you said, somebody tomorrow announcing they're buying Glen or for whatever reason. So that's a good mindset in general, Dan.
Yeah, thank you very much. And so let's go back and see what MenthorQ is giving us. You saw what happened with iRobot, $5 up last week, now bankrupt, or some CEO is leaving and stocks are going to the moon. The moon shots, if you have a long call, wonderful. If not, you're going to burn in the stars. So because we have just 50 minutes left, let's see how this trade is looking from MenthorQ perspective. We see for the closest expiration 125 call resistance. The put is at 115 and the high volatility at 120. We are below the high volatility level right now. So basically, let's see how this looks here. If you look here, on the downside, we're very close to the put support, which gives us confidence, but this one here is a bit further out. So what you can do if you really, really feel adventurous, and something which I don't basically encourage, try out everything. So if you just want to play the MenthorQ levels, let's see. We would have a higher break even on the downside, but on the upper side, it's only 5.7. Is this bad? No, basically LAN moves 5.8%, 6% in the last. So the loss wouldn't be that bad. And both data sets show us basically that we should basically be ready to cap the downside. But this is for people who really know what they're doing. And as you can see here from the probability, profit and loss, it doesn't look that good. So basically, if we have a high-word down move, still the things are okay, but on a high move, basically you got $2.5, and at some point you owe double of it. So this is not the way to do it. Another way could be to maybe try a butterfly, and we can try to find a butterfly which gets close to that. So this is 5.1, and this is again very good that it shows us this here. We have two at the money, where basically we're selling the short straddle and trying to go out here, but the platform already shows that we should be careful because we have low vol or high spreads on some of these legs. So this is something maybe we should avoid. And so let's see where the problematic spread is. And let's see if we can calibrate this one here. And another number I want to point you to is this here. This is the IV crush rate. I told you something 36 6%. So this is quite accurate what I had in the back of my mind. So if we build it like this, you see, this is not that good, because on the downside, where we should be more afraid, we would get burned very easy. And you remember from MenthorQ, the 110 is a level which is a magnet, but also a repeller. But if this breaks, as we saw from the DEX chart, we do have a problem. So how can we make this better? And let's go back here to MenthorQ. How can we make this better? We take the 5-day swing level, and we can try to put, build an iron condor here, something like that, and see if we can go a bit further down with that, but take advantage of this here, that we believe that the upper band, at least a week out, will stay there. So because it's just 1 day, this will be something which would be very, very helpful. Okay, let's clear that. And we had the 126 on the call side. Okay. 25, you see, this is the thing, and that's good that we show that to you. Leonard is a very company which doesn't move that much, but and that's why this is so good here. You see that if you have problems on the low volume or a high spread, then the whole trade can go sour and can go south because you pay too much. But still, we're going to build this thing now just to show you 112. So we would opt here for the put 111 and sorry, 111.
Yeah, on the short side, yeah.
Yeah, on the short side, and let's see, just do a very cheapish one, chicken style here. Let's see. You see, this is really hard to find something. 128. Okay, so let's build this the same way. We go 3 out, and again here you see
leg that's not so liquid.
Yes, and this is important. This is so good that we see this live. If you see liquidity is not on a lag, don't take the trade there.
Exactly.
So we built here something which we feel comfortable on the downside, but not on the upper side. From the data we have that LAN is moving 6% in average. From the other side, basically, and this is the nice thing, we build a skewed iron condor. And why this is something maybe which doesn't show, like the probability is not that good, but this is something you can see here. Basically, if we go up much high, you could lose a lot. But another thing, and why am I building this like that, is the statistics here are not the bad. But on the other side, you have the move of 6%. And this is something which should guide you. On the other hand, you have the levels of gamma, which do play a role when the earnings results happening. They don't have the same role as in every intraday where they act as magnets and repellers, because after an earnings event, things are reshuffled and basic positioning is happening anew, because institutions have to take out trades which didn't go well, or they unhedge or whatever. But what we saw in the move of the data and of the baseline at MenthorQ, we saw that there was a big change to the downside, and this is what we have seen at MenthorQ. And this is something how you could build basically a skewed iron condor, basically to protect yourself from the downside, to stay very close, but you still always have to have your mind here that this is your weak point. And basically that at 125, that's why we should build it a bit better. 125 is where basically the gamma levels can kick in. But I would advise you to skew a bit to the downside, but still try to stay out of these 6%, which is statistically the magic number for us to not get beaten up.
I think it's a great use case of basically then you showed how you would start with the non-directional symmetrical basically for a classic approach of short volatility, and then using the different data, especially what you saw on MenthorQ, it's a great use case of deciding that, you know what, I actually should be biased more to the downside, because as we saw in a lot of options, this seems to go down hard. So goes to show how you can adapt basically your approach to the specific outlook, and combine data from MenthorQ to know, oh, I should focus more on the upper side, the downside, and adjust your legs from there.
Yeah, and that's the thing. And for example, everyone who has seen me trade, I'm a big fan of calendar spreads and other stuff. And something which you can do, but this is very hard to do now, is if you have stocks like Leonard, you have a stock which normally moves less. You have the data here and can do anything with it, but you should always, and that's the main thing here. Earnings are a great way of taking advantage of basically high vol, having the right levels, positioning yourself. But you still need liquidity. You still need to be able to get out of a trade or to manage a trade. So even if all the signs are here, we have a data pick from EarningsWatcher. We have the data from MenthorQ giving you the next framework. And you want to build that stuff. And then you see, the way I want to build it doesn't work like that. We saw the strangles working, but this is risky stuff. So how can you basically fix the strangle? Either by selling wings very far out, like a lot of people do a trade, or another good trade would be, or rule of thumb if you do flies would be, you this is something we can do. You center around here where you are. Let me see, where were we? 120. You center around that, and then you sell like 3 times the premium you get, or 2 standard deviation. And this is something statistically which has worked good. Why is that? Because the wings are far out. They catch all these big fat tails. But this is a trade which normally stays in range. But again, I'm very happy that we chose this stock, which has great ways. I've played LAN a lot of times, and I'm not afraid to play it because I know how to manage that in the right way, and especially with these both data sets. But the important thing is, if you see a trade, even if you have the highest conviction and liquidity is not there, move on, do another trade.
I think it's a great point, to show the use case, the workflow, the general workflow that can be repeated with any stock. And here what we're seeing with them is just that extra step that we would like of, as you said, getting the short strangle, and then to be able to sleep well at night, cover it back with some even more out of the money legs. Here it seems that as we go far out of the money for land, the volume is not there for these really protective legs. So it seems that everything points to, sure, we can still play short volatility with whatever we have, but that extra step, because of the low liquidity, is not available. It's a great reflex to, have very high standards and say, I skip anything that is really not 100% liquid. And I think you're showing here on another example, like Micron, for example, where usually there's more liquidity, more flexible in this calibration, basically.
Yeah, and another way I want to show it here, and we can double check with MenthorQ data in a moment, is something you can build. Like if you really want to go in and say, where does this come from? Where is the basically, we always should know the biggest theta is on at the money, and plus also the volatility crush would be here best. So you would be selling the short strangle, but what can you do? We have shown that in a couple of cases, but not a lot of people are accustomed with. You can try to go 30 days out and buy yourself. Let me fix that, and then we go to MenthorQ data to see that. Let me just take out this call, which was... Okay, let's see that. So you see an IV drop here. So what did I do? I build out a short strangle here. I gave it a short straddle here and a long straddle there. So
the Dan trademark trade.
Yeah, time spreads can be difficult to wrap your head around, and there you can already start with a long some time ago to Ivy ramp that. But this is something here you can see 230 and 273. This is the break-even points, and where would I look? I would look at the statistics, but more importantly, also I would also look here, and Micron has far more liquidity than LAN, and I would go into MenthorQ, and we see high momentum here, high conviction here. You see far more green here, and we would take a look here, 250 and 205. If I go back here, 250 and 205. So this is the range, huh? And with this, what I built here, if I build that, I should really be sure that the Ivy Crush gets the move. If not, then I would be burned. So it's so important to know these levels where things are gonna stay here in the max capacity, and which again, for the end, which helps me, we see here we have a lower band. This means the 220 here, I'm very confident. The risk trigger here, yes, this is something where I can build things around. So if I go back here, again, you see, sorry, I didn't move that, 218 and 263. And you see here, on the downside, we are very confident we could go even a bit further down, but this is okay for us. We know that it should stay there, so we have to adjust that. But this looks very safe here with the 263 as a risk trigger if we are a bit above. So this is a way to calibrate, to see things, to use the data which you have at hand, and you build great trades. So this is something which gives you the Ivy Crush rate in the actual circle, and basically the longer one is not that impacted. But this is something maybe for another day. These are more complex strategies. I think we showed a bit more of a deep dive of what you can do, and maybe one very last thing, and then we are done here, guys. Is this is something we love here. Intraday data. This is basically this is the artificial intelligence MenthorQ has been rolling out for a long time, and you can ask amazing questions here. You can sit down and get yourself educated, and on EarningsWatcher you're going to find everything you need for education, and this is here in an AI. So if you sit down and you want to have your earnings trade and you don't have much time, and you have seen how the moves have been, you have checked your data in EarningsWatcher, and you want to have it very fast here, this is basically something to give you a very fast view on what's happening intraday, or you can ask it for levels here, and it can really help you get everything very fast, and ask it questions, and maybe give it questions about strategies and the levels, and it will give you good ideas and tell you maybe this is not a good idea, or this can be a bad idea, or something. So without much further ado, these are important levels.
And to add to that, Dan, I think Queen is very helpful for those who are starting.
Yeah,
so I think
definitely.
If you go back to Queen, and you can type in a question like, can you create a 7 days learning path to learn how to trade options, something like that, and basically it will provide you access to documentation that is on our website, academic courses, and a lot of really cool things that you might need to learn whenever you want to start trading options. So all of this is really organized for you. Links are there, so it's very structured.
Yeah, and if you come to day 4 and you want to, before you jump into the advanced strategies, you can take a look what you can see on EarningsWatcher. So you have the both platforms here. You get everything you need on volatility, and you already have understood the levels and market structure. And then you can take a look why it makes sense as a premium seller, for example, which a lot of people are to also trade earnings. And I hope we showed you something on a very small stock, which also is a big winner for the last years. We have great statistics on that at EarningsWatcher. And be aware of the levels, look at the statistics, try to see the levels, create a plan, and maybe in one of the further videos we can create a plan how to manage something if it goes well and how to not to manage if it goes wrong. And we can show live experiences, something we have set up, and how we saw by using the MenthorQ levels live when it's a good moment to stay in, harvest theta and vol crash, or when it's time to take your money and run, or how to roll out. And that will be the further idea for something we can do for you to feel more confident with your trading and use these amazing data to your discretion and for your consistency.
Very, very cool, Dan.
Thank you, Dan. Thank you, Dan, and thank you, Amin, for being here. I hope you guys enjoyed it. Today is so this week is the last week of the year, so we're going to be very busy with live sessions. So please stay tuned, follow us on YouTube, and then we're going to be back with Dan in the new year. So very excited about that. It's going to be a great 2026. So stay tuned, and again, thank you, Amin and Dan, for being here.
Yeah, and maybe we'll make some surprise for you guys. Maybe something small. Wonderful. Thank you so much, and everyone, enjoy the weekend and the week and the holidays, and trade safe and use the data right. And if you have questions, please tag me in the Discords, and don't be shy of questions. I'm sure we can help you answer all those questions. Thank you for watching.